Okay, we will start. We'll start. Good afternoon, everyone. Thank you for joining today's webinar. I feel as if this is a very exciting topic. I think this represents a real growth avenue for captive insurance companies in the future, and basically is how risk purchasing groups, health benefit administrators, and brokers can write third party, which is unaffiliated business in a captive. We'll have Travis Wegkamp, the director from the Utah Captive Division, to kind of like talk about the law that he's been seeing some good growth in the state of Utah, which CIC Services, a captive management firm, we have brought several of our clients to Utah under this law. And we actually have two actual cases. We got Ken Callison, who formed a commercial unaffiliated business, controlled unaffiliated business captive in Utah, along and also with Phil Cabell. With that stated, we're going to get right into the nuts and the bolts. Our biographies are at the end, but rather than waste the time on that, I kind of wanted to go right into it. And with that, I'm going to introduce Travis Wegkamp. And Travis, if you could take us through Utah's controlled unaffiliated business statute.
Absolutely. Appreciate it, Chris. Thank you so much for the invite. Happy to come here and provide a little bit of the legal or the regulatory foundation for doing this, what we call controlled unaffiliated business, or commonly referred to as CUBs. It's an avenue really to help captives get some third-party risk involved in their programs there and get some diversification with that. I guess briefly before I start, I think my bio is at the end of the slides that Chris will provide later. But yeah, I've been with the insurance department for a little over 14 years now, and around 9 years as the director. So again, thanks, Chris, and I guess we'll go ahead and dive right in here. So the definition for what a controlled unaffiliated business is in the Utah Code annotated there, section 31A, chapter 37, subsection 102. That chapter 37 there in our code is really where most all the captive information is contained, and supersedes any other information that might be in the insurance title. But yeah, controlled unaffiliated business means an entity, as you can see, they're not in the corporate or LLC system of the captive's parent company or one of the parent's affiliates. It needs to have a contractual relationship with the captive's parent or the affiliate. That contractual relationship itself, or just being a customer or a supplier or something of the parent or affiliate, doesn't necessarily mean there's a CUB relationship there, and we'll get into those standards in a second here. Additionally, risks that are or will be insured by the captive need to be managed by the captive insurance company itself, or by that parent or affiliate of the captive. And then it says needs to be managed in accordance with 31A 37106 there. And what that really does is it refers to the ability of the commissioner to create some standards back in the Utah rules that define what a CUB relationship, or really show what a CUB relationship is. To this point, we have not created those specific standards or created kind of, I guess, what would be a one size fits all for these relationships. We leave that up to you as the captive at this point to submit to us what your program is and what your CUB relationship is and how that's going to be defined and what standards are going to be there to basically ensure that you have that control over the risk management functions of this entity or this CUB that you want to be able to insure directly in your captive.
Travis, I just want to make one point, Travis.
Yes.
So while, like Travis just stated, he looks for the client to bring their risk mitigation or their control over the business to Utah. I will say that one of the things what I really love about the Utah Captive Division is that they're very consultative. So when we talk about our first case will be coming up shortly, from that perspective, we weren't certain kind of what they were looking for, but Travis and the staff were able to say this is kind of like what we're looking for with other companies. And so he does kind of guide you through the process to help you uncover really that you are providing those risk mitigation strategies. But thank
Certainly,
you.
yes, we're always open to having discussions. So if you're unsure and you want to maybe get some insights, by all means contact us, and we're happy to set up a meeting and understand what your company is and what you're looking to do. And then maybe we can discuss some ways that we think might be a good place to start in order to achieve those standards that we might then consider to be a good cub relationship and therefore be able to insure in your captive. We're always happy to do that. Doors always open. We've worked with Chris and several of his clients in that regard as well. So always happy to do it. Lastly, there you can see there's a list of the types of captives that are allowed to directly insure these cubs. Currently, it's pretty much every sort of captive, pure, sponsored, and then it sells an RRG. The only one currently that we license here in the state, but doesn't specifically give authority to insure cubs are the association captives. Generally, those exist just to insure the risk of its members. I decided, let's go ahead and put that in there and see what kind of program they might propose if they think there's an avenue for the association or its members to kind of delve into this controlled unaffiliated arena, if it works for the association. So I figured, why not open that up and see what kind of proposals they might have in the future rather than just shutting the door entirely. So that's going to be a proposal that's in our upcoming legislation for 2025. Our legislature meets typically during the month of February, around there. And if that passes, which I expect it will, it'll go into effect for May 2025. That's really all I've got at this point for kind of the basics. Happy to answer any questions, Chris, if you want to do that now at any time or save it
Yeah,
till later.
not a question, but I do have a follow-up comment. When I talked about Travis's consultative nature, when I retired from the Connecticut Insurance Department in December of 20, the next case study I'm going to introduce Ken Callison, and he was interested. I approached Ken Callison because he actually ran a risk purchasing group for 30 years and had a 30-year loss ratio of between 25 and 30%, which means he provided the insurance industry with a 70 to 75% profit ratio. But we were having difficulty finding a fronting reinsurance and a back-end reinsurer due to the amount of premium currently in that risk purchasing group, which was at the time I think was like 1.2 million. But I came across this law and I said to Ken Callison, who will be introduced shortly, I said, Ken, if you could write this business directly, would you? He goes, absolutely, I would. And I had actually called, like one of the first tasks, I called like 10 states who had this law. And I said, do you have this law, controlled unaffiliated business? They go, yes. I said, can you define it? And the first 9 states, you could hear the hesitancy in their voice because it's not just insuring first party business, it is insuring third party business like the traditional insurance industry, which causes the regulator had to be a little bit more concerned. They want to make sure that the assets will always be there to cover those risks. But I saved Utah for last. I called up Travis. I said, Travis, do you have this law? He goes, yes. Can you define it? He goes, yes. It'll be in your in basket in like 10 seconds. So he emailed me this loss control services agreement. He goes, this is kind of what we're looking for to demonstrate that your client has expertise over the business's risks. So that's why I say when I talk about his consultative nature, I can't emphasize enough that they do a great job with that. I'll
Yeah,
pause for
thanks,
any.
Chris. So yes, defined as control over those risk management functions, but how you get there, we'll leave it up to you, and we'll definitely work with you in that regard. But thank you, Chris. We've certainly appreciated getting to know you and working with you and your clients there. It's been a great working relationship, and I appreciate the way you're taking advantage of this avenue here in Utah and bringing business our way.
And I've been telling people, I kind of feel as if I'm kind of surprised the traditional insurance industry, I think the lobby group, they're kind of like asleep at the switch. I'm surprised they let this type of law, because I think in time you're going to see more and more captive insurance companies insuring third party risk. I think it's going to continue to grow, but right now it's under the radar. A lot of people don't know about it. So I kind of tell our company that we work with and all of our clients, I say, I think this represents a tremendous growth for a lot of businesses. And
Absolutely.
so with that stated, who are candidates to write third party business? So for example, a health care benefit risk mitigator administrator. There are companies out there that they manage risks, health insurance risks for the companies. They're expert in noticing fraudulent claims or making sure there's no overcharges, though they got a real skill set. So I actually worked with a company who was in that space, and he went on to form his own captive insurance company because he says, "Hey, I'm expert at this. I've been doing it my whole career. I'd like to take a layer of this risk for all my clients." I talked about risk purchasing group operators, which Ken Callison is. Ken Callison, like I say, risk purchasing group is where you aggregate. So Ken, for 30 years, would aggregate like 1,200 beauty salon owners. He'd pull 1,200 of them together, and then after he'd get that quantity discount, he just like Home Depot gets a better deal than the mom and pop hardware store. Ken would go to the insurance market with 1,200 clients and procure a better deal. But Ken Callison just didn't aggregate them. Ken would always put in risk mitigation steps to keep the losses low, because even if you have a lot of clients, if you're real sloppy on your risk mitigation, it's going to implode and the carrier's not going to want to participate. Warranty providers to first party business. There's a lot of people who run automobile warranties. They're expert in that. So I used to tell people, I said, if you do that for all these other clients, you could actually form your own captive insurance company and you can put that business into a captive insurance company. I've been working with a couple clients. They are preemptive cyber liability risk mitigators. They feel as if their loss ratio, once they have those preemptive risk mitigation strategies in place, they think their loss ratio is going to be like 6%. And this is especially important because I pulled up the insurance services office's policy language, which all like carriers base their policy language on. And for cyber liability, it has an exclusion. It says any hack from a foreign country is excluded from payment. So then I'll ask the people, the clients, I said, do you know what percentage of hacks come from foreign countries? They say, well, it's a lot. It's like 99%. So we tell our clients, we got some clients paying $300,000 a year in cyber liability premiums to the traditional market. And I said, you're just basically kissing that money goodbye because they're not going to pay on any claims. And then in highlighted, I have any demonstrated expertise. So like I said, if you don't have that demonstrated expertise, Travis rightfully will not approve forming a captive for that regard. So it's our job as captive manager and the clients, when we go to Travis, we're going to prove the demonstrated expertise, why we think there's going to be a low loss ratio business. I'll pause for any questions or comments. Okay.
Not so far.
Okay. Hearing none, we're going to go to Ken Callison. So Ken Callison, you want to introduce yourself, Ken?
Yeah. It's Ken Callison. I live in Arizona now. The company is still in Denver, Colorado, so I work remotely. And as Chris said, we had a program for many years with different fronting carriers that took 100% of the premium and 100% of the risk. But I ended up doing at least half the work on the claims and all of the marketing and running the association, running the insurance program. So when I came across CIC and this program that Utah has, it was a natural fit. I wish we'd started a little bit sooner, but it's been great. You know, Utah is very business friendly, very responsive and easy to work with. Same to CIC. So it's the captive's been going for 2 years, but it's been actually quite pleasant, profitable, wonderful experience. It's a lot of work, but it's worth it because you get one of the things you get out of this in working with an organization like CIC and domiciling in Utah, you get a certain amount of control over your own life, whereas you don't get that with a fronting carrier. So that's another advantage. Certainly the profit potential is there. You have to be comfortable with the risk and be able to manage the risk. But we had done that for many years. So this was a natural segue for us.
Ken, can you talk about the risk mitigation strategies that you've implemented over the years that has helped you keep those low loss ratios?
Well, one of them is that we have, of course, we're in the spa beauty salon industry, medical spa industry. And so we require about the only thing we require other than disclosing everything on the initial application, we do have a consent release that we require the spa to get signed by the customer. It's just really on the first visit, ask them to get it signed every year, but it's a pretty comprehensive consent release. And it's just basically the way I look at that is dressing for winter. You kind of have layers of clothing to keep yourself warm. Well, having good insurance coverage and using a consent and release and your technicians being properly trained and having an understanding of the industry and the customer service that the end user expects. All of those contribute to a reduction in losses. The communication we have with our clients, our salon and spa owners, is pretty extensive. And I think the fact that they can reach us easily, we actually still pick up the phone. That helps in mitigating and preemptively mitigating risk.
Okay, good. So now the loss ratios have been low. So has your captive been you said you wish you started this earlier. So I'm assuming, and I know, but it's been profitable. Your captive has been profitable.
Yeah. Mm-hmm.
And then recently, so sometimes a lot of times people will start off with one line of business. And I know because we're the captive managers that you recently added a health insurance line to your captive. Can you tell us a little bit about that line of business?
Well, we actually haven't added a health insurance line yet. It's in the works.
Okay.
And we are working with a number of large wholesalers to bring their book of business over to the captive, but it's within the same industries that we're currently within.
Okay, the beauty salon and the medical spa type business.
Yeah,
Okay. So it's a natural growth from what your expertise is right now.
it is. And of course, the objective is to expand into sister industries that are somewhat related.
Okay. All right, that'd be good. That'd be good. Any other questions for Ken Callison right now? Okay. We'll go to our next case study, which is Phil Cabot. And he actually is very interesting. He writes third-party medical malpractice business in a captive. Is that, and Phil, can you introduce yourself and explain a little bit about these bullet points up here on the screen?
Sure, happy to do so. Phil Cabot, and I've been in the medical malpractice space for a little over 20 years, starting on the carrier side, then moving into the managing general agency side. And while acting as a managing general agent, I've been fortunate enough to form several different captives for either associations or medical groups, hospitals, healthcare systems over the years. So I've done quite a bit of captive work, but usually just pure captive self-insurance or an association captive where everybody buys into the captive who gets coverage, kind of like a mutual type of coverage. So this is my first experience with, unaffiliated business in a captive. A little bit more about my background. I do specialize in physicians and physician placement risks. So locum tenens physicians and temporary placement physicians. And now getting into this captive opportunity, one of the things that happened as a trend in that industry is over the last, I would say, 5 or 6 years, the litigation profile has changed dramatically. And now I'm getting into some of the bullet points on the slide here. The industry used to be a death by 1,000 cuts type of exposure, where inmates in correctional facilities had access to legal representation, or they could represent themselves in a claim and sue their healthcare provider. And in the prisons, it can be very challenging to give good quality healthcare to inmates because of how volatile the living conditions can be. And so med mal carriers who insured physicians that worked in these environments would see a high volume of claims, but they're usually very low value. And so it could be settled for $5,000 to $10,000. What we saw in the last 5 or 6 years is a change in that severity profile. So you still had the frequency of 1,000 cuts, but the average value of a claim increased dramatically, especially following the George Floyd litigation and in the kind of public outcry for changes in law enforcement and how inmates are treated. And it wasn't just George Floyd. There were a series of other incidents where people died in jail or while handcuffed in kind of police custody. And so there was a severe uptick in the value of these claims because of the outcry socially for reform in that area. And so now inmates aren't representing themselves. They're actually represented by real litigators and real lawyers who are taking these cases up. And so we saw the value of these claims go from tens of thousands of dollars to hundreds of thousands of dollars, or in the case of like high profile cases like George Floyd, millions of dollars. And so that changed the profile of risk dramatically for physicians that were staffed in correctional facilities. So as that shift changed, a lot of carriers pulled out of that space. And that's what drove the need for this captive. I would say that if this space had 20 carriers interested in it 5 or 6 years ago, that list is now 3. And so the rates have gone up proportionate to the lack of capacity. So we've seen probably a 4 or 5-fold increase in the average rate. And then coverage terms have gotten a bit more restricted or punitive as well. So the opportunity that we saw in this space was, and I have formed captives for the physician staffing industry in the past, but is to work with insureds to try to change from the inside. And when I formed a captive in the past for the physician staffing industry, we did it as an association captive. And so each of the insureds owned a share of the captive. And what we found was there's a challenge in doing that because capital calls were an issue. Agents' relationships became political. Because I am an insurance agent and an MGA, independent insurance agents maybe didn't want to work with me as a program administrator and had their own captive management team. So if you're interested in the captive, let me form your own. So we had a lot of friction points in getting kind of a critical mass into a group captive. So this structure that we have where we can write separate and independent businesses through a captive structure kind of eliminated a lot of that friction, in that I could do the heavy lifting of the policy form creation, the capitalization, and the creation of the entity, and then sell the product as a commercial product to insureds that are interested in a solution and working with us essentially from the inside out, but didn't have to deal with the capital call issues and the other politics that come into the insurance transaction. We can just work with their agents as any other carrier would, and work with them on that basis. I'll pause there for a minute.
Yeah, no, that's excellent. Fascinating story. And that's why when we talked about early demonstrating expertise, so from Travis's standpoint, we bring him Ken Callison, who had this risk purchasing group for 30 years, and it was mitigating the claims. And also Phil Cabot, he's been doing this for 20 years, forming these captives for people forming, like covering first party risk. All of a sudden, when there's this need for third party risk, this opportunity, it was an easy sell to Travis, because Travis could see their demonstrated expertise in both of their respective fields. So these are the types of captive opportunities. If people here are on this webinar, if you feel as if you've got this type of expertise, especially in what always gives birth to the captive market is always when there's a coverage and capacity issue. Like Phil talked about, there used to be 20 carriers, now they're down to 3. I remember when I was a regulator in Connecticut, hospitals' medical malpractice insurance went up like 10 times in a year because all these carriers were pulling out. And that's the perfect segue for a hospital to say, hey, I'm going to form my own captive insurance company. Now these premiums are exorbitant. We might as well pay those same exorbitant premiums to our own captive insurance company. So yeah, so Phil talked about capacity cuts, coverage issue. Uh, what about a mandatory risk mitigation strategies, Phil? Do you require those of candidates that you insure?
We do. And for us, kind of the risk mitigation falls under two sides of this fence. One is um, we used to say in the medical malpractice space, the best way to get a physician to reform his behaviors is to hit his pocketbook. And so just increasing the premiums dramatically tends to get their attention. And unfortunately, in this particular case, we're not really working with individual physicians, though we're working with the staffing companies that place physicians within these facilities. And it can happen still. That rate increase is a good way to get their attention at an institutional level, these corporations. So we get their attention with the rate increase. We reform or change the trajectory of these liabilities through coverage changes as well to try to flatten that curve so it's not as spiky. And then the third part, on the other side of the fence, is talking to them about the reform that needs to take place within these organizations at an institutional level. And I can't say that we can change this ourselves, but we can do our small part, and that is bringing awareness to civil rights issues and inmates' rights, and trying to create more of a humane structure and treatment around how healthcare is delivered in a prison. And so part of it is just focusing in a spotlight on what the civil penalties are for violation of civil rights, because it's so easy, like when you're in this kind of jungle environment, to just go into survival mode. And the healthcare providers are in this survival mode too, because this can be a very violent environment for them as well as healthcare providers. So trying to create an environment where they can maintain some kind of view around the civil rights and how these people need to be treated in a more humane fashion is part of our kind of risk management that we want to push down as an institution into our clients.
Okay, good. And Phil, I asked Ken if I know he was thinking about expanding to the health care. Do you see any other opportunities where you can add to your captive, Phil, on a going forward basis?
When we formed it, we just had this one use case in mind, but what's happened that's very interesting since we formed this, and this has only just been 4 months since we formed the captive, there's been a lot of disruption in the medical malpractice space overall. So we're hearing rumblings about hospital professional liability carriers pulling out. One carrier in particular that used to offer $25 million in limits as an excess provider has now cut their limits to $5 million. And now the rumor is after January 1st, they're going to be completely out of the market. Another med mal carrier in the physician space has raised rates 20% on their E&S product. So there's a lot of volatility right now in what we would consider the more standard areas of the marketplace. So we want to keep our ears to the ground and look for opportunities to expand in this more traditional segment as well.
All right, and a lot of times when we're talking to clients, I said, don't form a captive with your goal to lower your premiums in year one. We say, no, listen, pay if the traditional market is charging exorbitant rates, we say pay yourself those, but pay yourself those same exorbitant rates. And then with good risk mitigation strategies, you got money left over. So then your net premium, the premium you put in, the high premium you put in, minus your profitability, now your net premium might be 50% less than what your gross premium was. And
I
that's what
agree with that.
yeah, it
Yeah,
gives
you want
birth.
to
Go ahead.
right. You want to build a war chest of capital within your captive. And so then ultimately you can lower your rates or your funding requirements in future years, but you need to build that war chest on your balance sheet.
Right. And also a crisis. So there was a client that we're talking to Travis about, like homeowners associations, like all the wildfires in California or the hurricanes and no wildfires in California, hurricanes in Florida. So Travis, isn't that true? Like all of a sudden now you might have another opportunity for companies to write like homeowners coverage or condo coverage. Can you explain a little bit about that?
Sure. In our last legislative session, we did pass some changes to association type captives, not restricted to HOAs, but really any association that creates an association type captive. We opened up the avenue for them to insure or write the personal homeowners policies for their members that are struggling to find coverage or get affordable coverage. So we're exploring that. We've gotten a lot of interest in it. Haven't yet had anybody pull the trigger on it and really give us an actual on paper proposal of what they plan to do. But yeah, captives have been a great area for making those changes, trying to respond more timely in issues in the market. And so we felt there was an opportunity there. And typically that stuff is restricted, not allowed, those personal lines in the captive, but we felt with an association type captive, we could give that a shot and see how it goes. And I might go ahead and add one more thing to Phil's last slide there. I didn't initially, wasn't going to get into it, but I really did like his last bullet point there. When it comes to setting up those or presenting your standards to us in order to create a cub relationship, as you know, Chris, that last bullet, that's really typically the main recommendation that I like to give to companies that want some input from us, is to set up really a mandatory risk mitigation strategy. Put in paper what these outside entities need to do in order to be insurable by you. And demonstrate that there's a reporting function in place or oversight in place to make sure that they're doing those things. And then establish maybe some consequences or changes, timeline for making changes, things like that, if they're not keeping up with those mitigation strategies. That to me is a great foundation and the best starting point for creating a cub relationship. So thank you, Phil, for putting that in there.
Yeah, and that is key. And some of the success stories, I know the person, I forgot his name, who ran the Housing Authority Risk Retention Group. I remember him, he always had these mandatory risk mitigation lunch and learn webinars, like during the week, you'd have to attend these. And he would say, like, for example, like in the main entryway, perpetrators would go and they would break the light because there would be a camera there. They'd break the light. So this way, when someone came in, they could accost them, but it wouldn't be caught on camera because there's no light. So then this person mandated that those lights that are in the entranceway have to be behind like bulletproof glass. So this way a perpetrator can't go and break it. They have no access to it. So now the lighting's always there and the camera's always there. And those are the like little things that he would institute over his long career that kept the losses down. And there's an inverse relationship between as losses go down, profitability goes up. So being a former regulator, and now I'm on this side of the fence, but risk mitigation is huge, not only for the regulator, but also for our captive clients. Because I say, what good is it if you go through this whole process, if you're going to be sloppy or unattentive to the risk mitigation, your captive is going to implode in a year or two, and you wasted everyone's time. Competitive advantages. Captive insurers are not bound like traditional insurers. I've made the observation where traditional insurance companies, they'll say that, oh, they're regulated by the states. But I've observed the governing bodies, the National Association of Insurance Commissioners, which has brought a lot of great ideas to unifying the industry. But I kind of feel as if amongst the states, there's no innovation because they all do it the same way. Where in the captive world, it truly is state regulated or jurisdiction regulated, and there's no governing body making sure everyone to do it exactly the same way. So I feel as if because of that, there's a lot of more innovation in the captive world, and we continue to see that every year. For example, there's legal workarounds to expensive state health mandates. There are some states that mandate every particular procedure be included. So we work with companies. We'll say, listen, if you form a captive insurance company, and if you're in a particular state with these really restrictive health mandates, you could actually form your captive in another state. Therefore, legally, working around those expensive health state mandates. Captives are not subject to state guarantee of fund assessments. Again, Travis and I were just on a call in this past week or two. Again, that is a homeowners association, the ones that's got the good risk mitigation strategies. They brought up about how a company was poorly managed and there was guarantee fund assessments. And I said, yeah, you're not covered by the guarantee fund, nor do you have to pay guarantee fund assessments. He goes, that's what I was trying to get at. So he's very happy about that. You can be licensed in one state, but write coverage in many states, which is an advantage over the traditional market. Um, and also, when you have demonstrated expertise and experience, like both Ken and Phil have, you can write profitable lines of business. We feel as if also the captive policy language benefit the business owner and the captive owner. The policy language is benefit the business owner, but also you could also protect all parties with good, sound policy language. Underwriting results inure to the business owner and the captive owner rather than like Ken Callison talked about. He had a 30-year running that risk purchasing group with a career to like 25 to 30% loss ratio. So he, over 30 years, that traditional insurance industry is very grateful that Ken provided them with a 70 to 75% profit ratio. But now Ken Callison's on the receiving end of that profitability. Client retention. If you start mandating a good risk mitigation strategies, the loss ratios stay low. You don't have to all of a sudden spike up the insurance premiums for your clients, like what Phil was talking about in the traditional medical malpractice field, where all of a sudden rates are going up like 20 or 25% and capacities continue to go down. If you get clients to say adhere to these risk mitigation strategies, the loss ratios will stay down, your future premiums will stay stagnant. And Ken talked about more control over your business, your future, and your independence when you do it yourself. And I also feel as if the captive world adapts to the marketplace very quickly. Phil was just talking about how he's been noticing just since the 4 months that he's formed his captive, that all of a sudden he's been hearing about all these rumblings about coverage and capacity issues in the medical malpractice space. And I feel as if the captive world will be able to adapt to it very quickly. I said a lot. Any questions on that? Hearing none. This will be available to all the attendees, but this is both Travis Wegcamp's biographical affidavit, Ken Callison's, Phil Cabal, and mine. And we just talked about if anyone out there is interested in exploring this, if you feel as if you got the expertise of a Ken Callison and a Phil Cabot, we'd love to hear from you. We could start, there's a complimentary questionnaire. We could look at it and we give you like a customized model complete with financial projections, what we think it'll look like. We've got the necessary disclosures and a little bit about CIC services. We've been getting a lot of awards lately. We really take the side of our clients. One of our clients took the IRS to court, and we took it all the way to the Supreme Court. And in 2021, the Supreme Court ruled 9-0 in our client's favor. So that was a very big victory for CIC Services, our client, and the captive industry. It kind of led the way to us winning Captive Manager of the Year. We've won it 3 times in the last 4 years. We won it in 24, 23, and 21. That's with the Supreme Court right there. And if you have any additional questions, there's my email and my contact information. I thank our presenters, Travis, Ken Callison, and Phil Cabot. Thank you very much for those giving your own personal experiences. I think it's really interesting when we have actual case studies. And with that, does any of our attendees have any questions they would like to ask us while we're here? Hearing none, I'm going to give you guys another like 25 minutes of your day. I thank you very much and have a blessed rest of the day.